In the fall of 2025, a car parts company you've probably never heard of quietly took down a piece of the financial system. The company was called
First Brands.
First Brands.
First Brands.
First Brands.
First Brands filed for Chapter 11 bankruptcy.
It had billions of dollars more in off-balance sheet financing.
It made brake pads, wipers, filters, the boring stuff sitting in your garage right now. And for years, it looked like a normal, profitable business, borrowing money the normal way. Except it wasn't. Investigators would later find invoices that had been inflated by hundreds of times their real value. One invoice for $179 and change got quietly turned into a bill for over $9,000. Multiply that trick across thousands of invoices year after year, and you start to understand how a company built a mountain of debt that almost nobody could see. There was also a slush fund. Investigators gave it a name, Bowery Finance 2. And through it, prosecutors allege, the founder pulled out more than $700 million for himself, while lenders kept handing over cash, thinking it was backed by real assets. When forensic accountants finally opened up the company's books, they found something almost funny in a horrifying way. The special accounts that were supposed to be holding cash as collateral had no cash in them, just paperwork, just promises. First Brands collapsed almost overnight. Billions vanished. And banks like Jefferies and UBS, who thought they were safely lending against real invoices, suddenly found out they weren't. Here's the part that should really get your attention though. First Brands wasn't borrowing from a bank you'd recognize. It was borrowing from something else entirely, a sprawling, mostly invisible financial system that now moves more money around the planet than all the world's traditional banks combined. It's called shadow banking. And even though you've probably never used that phrase in your life, it's already touched your mortgage, your retirement account, and your last paycheck. To understand how something that big could be sitting right under our noses without most of us noticing, we have to start with the simplest possible question. What actually counts as a bank? Picture the word bank, and you probably picture a building, maybe a guy in a polo shirt asking if you'd like to open a savings account. That's a real bank, the kind with a government license, deposit insurance, and a mountain of rules it has to follow. Now imagine an entity that does everything a bank does, takes in money, lends it out, makes a profit on the spread, but skips the building, skips the license, and skips almost all the rules. That's shadow banking in one sentence. Same job, none of the paperwork. Instead of a savings account, shadow banks might use something called a money market fund, which pools your cash and other people's cash and uses it to buy short-term IOUs from companies and governments. Instead of your local bank vault, they use something called the repo market, where firms lend each other money overnight using stacks of financial paper as collateral, then unwind the whole trade the next morning and do it again. It sounds harmless, efficient even, and for a long time, it was treated that way as this quiet, background plumbing of the financial world, moving trillions of dollars a day without anyone really asking who was watching it. Then came...
It was a manic Monday in the financial markets.
The company is now bankrupt. Our economy is in a state of crisis.
Soaring gas prices, falling home prices, and rising unemployment.
You already know the broad strokes. Housing prices crashed, and the whole economy nearly went down with them. But here's the detail most people miss. The companies that actually blew up first, Bear Stearns, Lehman Brothers, weren't traditional banks at all. They were investment banks, funding themselves almost entirely through the shadow system. Overnight loans, repo deals, short-term paper that had to be constantly refinanced. Like a business running its entire operation on a credit card, it pays off every single night. Lehman even had a trick for making its debt disappear right before earnings reports. Bankers nicknamed it Repo 105. Lehman would temporarily sell assets right before reporting its numbers to investors, make its balance sheet look cleaner than it actually was, then quietly buy those same assets back days later. Just enough of a shell game to keep regulators calm. It worked until the 1 week it didn't. When lenders got nervous and refused to roll over those overnight loans, Lehman had no deposits to fall back on, no emergency line to the Federal Reserve, nothing. In days, one of the oldest investment banks in America was gone. And that's the core danger of shadow banking in a single image, a system built on money that everyone can pull out overnight all at once, with no safety net underneath it. You'd think, after nearly blowing up the global economy, this system would have shrunk. It didn't. It got bigger, way bigger. And to understand exactly how much bigger, we actually have to go back a lot further than 2008, back to a trick invented by medieval landowners trying to dodge a tax bill. Here's a fact that sounds made up but isn't. One of the basic building blocks of modern shadow banking is a legal trick that's about 700 years old. Back in medieval England, if you owned land and you died, the crown got a cut. Death taxes, essentially, baked right into the feudal system. So English landowners came up with a workaround. Instead of technically owning their land, they'd hand it over to a trusted friend who held it for the benefit of the landowner's family. On paper, the friend owned it. In practice, the family still controlled it and used it. The crown couldn't tax what it didn't technically belong to anyone in particular. That structure got a name, the trust. And it's still the exact same basic idea sitting underneath the modern offshore world today. Fast forward a few centuries, after World War I, tiny European countries like Liechtenstein realized they could turn friendly trust laws into an entire industry. Show up here, park your money in an entity that's legally separate from you, and you get privacy, and often a much smaller tax bill. Switzerland leaned into this hard, staying neutral through 2 world wars while its neighbors were busy printing money to pay for tanks, which made it look like the safest, most stable place on the planet to quietly stash your fortune. By the 1960s, London got in on it too. British regulators quietly agreed not to police certain foreign currency transactions happening inside their own city as long as they were technically happening offshore. That loophole gave birth to what's now called the Euro market, trillions of dollars a year, moving through London, regulated by basically nobody, because on paper, none of it was really happening in Britain at all. This is the pattern that shadow banking runs on again and again, whether we're talking about medieval landowners or modern billionaires. Find the line where the rules technically stop applying and set up shop exactly on that line. It's not usually illegal. That's what makes it so hard to fight. It's built entirely out of loopholes that were, in some form, put there on purpose. And once you understand that pattern, the scale of what it's grown into today becomes a lot easier to wrap your head around. Let's talk numbers for a second, because they get genuinely hard to picture. Back in 2009, right after the crash, the entire global shadow banking system held around $28 trillion in assets. That was already a massive number. By the end of 2024, according to the Financial Stability Board, the group of regulators who track this stuff worldwide, that number had crossed $250 trillion. Picture a pie chart of the entire world's financial system. Slice it up, and more than half of it, the majority slice, now belongs to non-bank institutions, hedge funds, insurance companies, private equity, investment funds you've never heard of, holding assets bigger than most countries' entire economies. In the United States specifically, one corner of this system has been exploding even faster: private credit. These are firms that lend money directly to businesses, completely outside the traditional banking system, usually to companies that banks think are a bit too risky or that just don't want the paperwork that comes with a normal bank loan. Back in 2010, banks had loaned out around $56 billion to these private credit and shadow lending firms. By early 2026, that number was past $1.4 trillion. That's not a typo, and that's not normal growth. That's a 2,500% increase. While regular mortgage lending grew by less than 40% over the same stretch, why now? Part of the answer traces back to one specific bank. In 2018, regulators put a hard cap on how big Wells Fargo was allowed to grow, as punishment for a scandal involving millions of fake customer accounts. For 7 years, Wells Fargo was basically frozen in place, while its competitors kept growing around it. Then, in June of 2025, regulators lifted that cap, and banks across the board saw their reins loosen too, as a wave of deregulation rolled back stricter capital rules that had been planned in the years after 2008. With more room to lend and fewer rules slowing them down, Banks didn't send that extra money to Main Street, to your local hardware store, or your neighbor's small business. A huge chunk of it went straight into shadow banking, funding the very same private credit funds that are now lending to companies with a lot less oversight than a traditional bank loan would ever allow. Regulators have actually started sounding the alarm on this exact wiring. By the start of 2026, banks had over $2.5 trillion in loans and credit lines committed to these non-bank lenders, an amount bigger than the bank's entire cushion of spare capital. Which means if the shadow system stumbles, it's not going to stumble alone. It's wired directly into the same banks that hold your paycheck. And if you want to see exactly what that stumble looks like in real life, we're back to where we started this video, a car parts company in Ohio. Let's slow down and really look at what happened at First Brands, because it's basically a museum exhibit of everything that can go wrong in shadow banking all at once. First Brands wasn't some tiny startup. It owned recognizable auto parts brands, supplying stores across the country. But behind the scenes, the company was borrowing money in a way that was almost designed to confuse anyone trying to track it. Instead of one simple loan, First Brands stacked up multiple layers of financing, regular loans, separate credit lines, and 2 different factoring programs, meaning the company was selling its unpaid customer invoices to outside lenders twice over to get cash faster. Here's where it turns from aggressive into fraudulent, according to investigators. The same customer invoices were allegedly pledged as collateral to more than one lender at the same time. Imagine selling your car to 2 different buyers on the same afternoon, collecting a check from each one, and hoping they never talk to each other. Do that with invoices, thousands of times, across years, and you can raise a shocking amount of cash that isn't actually backed by anything real. On top of that were the special accounts, the ones that were supposed to be holding cash as a safety cushion for lenders. When the forensic accountants finally cracked those open during the bankruptcy, the accounts were essentially empty. All the confidence lenders had in those numbers turned out to be built on paperwork nobody had bothered to verify. When it all came apart, the math was staggering. Over $6 billion in debt that was sitting right there on the books, plus more than $2 billion in financing that had been kept off the books entirely, hidden from the very lenders whose money was on the line. The fallout rippled outward fast. Banks like Jefferies had hundreds of millions of dollars of exposure, thousands of workers across plants in Ohio, Texas, and Tennessee got layoff notices. And regulators from the Bank of England to the International Monetary Fund started asking the exact same nervous question out loud. Is this one bad company? Or is this the first crack in something much bigger? That question matters, because remember, Section 3 banks have trillions of dollars wired directly into this exact corner of the financial system. First Brands wasn't an isolated island. It was one loose brick in a very large, very interconnected wall. And regulators are now watching for the next brick, because privately, more than a few of them expect there to be one. But step back from the headlines and the huge numbers for a second, because there's a much more personal question sitting underneath all of this. Does any of it actually touch your life? The answer is yes, probably more than you'd guess. You don't need a hedge fund account or a Swiss trust to be plugged into shadow banking. Odds are you already are. Start with your mortgage if you have one. When you send in your monthly payment, there's a decent chance it isn't going to the bank whose name is on your paperwork at all. Many mortgages get bundled together, sliced into pieces, and sold off to investors, pension funds, insurance companies, investment funds, as part of the exact securitization process that helped trigger 2008 in the first place. Your bank might just be the middleman collecting the check and passing it along. Then there's your retirement account, if your employer offers one. A chunk of that money likely isn't sitting in cash. It's spread across investment funds, and increasingly, some of those funds have slices allocated to private credit and other shadow banking vehicles, the same category of investment that just took a hit from things like First Brands. Higher potential returns, sure, but also less transparency about what's actually happening to your money behind the scenes. Even your paycheck touches this system more than you'd think. Plenty of companies, including ones you buy from every week, cover payroll and day-to-day expenses using something called commercial paper. Short-term IOUs sold to investors, refinanced every few weeks like clockwork. It's basically shadow banking's version of a company running on a very short leash of borrowed cash. When that market freezes up, like it briefly did in 2008, paychecks can bounce, hours can get cut, and it has nothing to do with how hard anyone worked that month. And if you keep spare cash in a money market fund, thinking of it kind of like a savings account, here's the twist. It isn't one. It's not federally insured the same way a bank deposit is. It's a shadow bank, dressed up to feel exactly like a regular one, because that resemblance is what makes people trust it enough to use it in the first place. None of this means the system is destined to collapse tomorrow or that you should panic about your mortgage statement. But it does mean this enormous, quiet machine isn't some far-off Wall Street abstraction. It's laced through the ordinary financial plumbing of your actual life, whether you ever hear the phrase shadow banking again after this video or not. So here's where all of this leaves us. A car parts company in Ohio, a 700-year-old tax trick, a $250 trillion web of funds and lenders, none of it was ever really separate. It's one long thread, stretched from medieval landowners dodging a death tax, all the way to the fine print on your last mortgage statement. The traditional banking system is the part we can see, the branch on the corner, the app on your phone, the rules everyone agrees to follow. Shadow banking is everything built to sit just outside that frame, doing the same job without the same guardrails. And every time regulators tighten the rules on one side, more money simply flows to the other, because that gap is exactly where the profit lives. It grew after the last crisis instead of shrinking. It's bigger today than it's ever been. And the next time part of it cracks, there's a good chance it won't announce itself with a headline about shadow banking at all. It'll just look like a car parts company quietly missing a payment. And the ripples reaching a lot further than anyone expected.